Hello friends, today's video is regarding the most important book that every investor must read, and it is a book that is The Intelligent Investor by Benjamin Graham. He was a very successful investor, and this book is literally prescribed by Mr. Warren Buffett, and he has even said it publicly that with this book his life totally changed. Before reading this book, he was having a different perspective upon investing in stock market, and after this he had a very changed view of how to make money in the stock market. In fact, he came out as an investor rather than a trader or a speculator. So we can see that in this book you have got 20 chapters. These are the 20 chapters that are in this book, and I would say these chapters, they range from, they start with difference between investment and speculation, which everybody must know. Then there are links being made that how investment and inflation are related. So, an investor and inflation, there is a chapter dedicated to that. Then there is chapter 3rd, which basically deals with the history of the stock market. Then there are two types of investors which are described in this book. One is a defensive investor and another is an enterprising investor. And any kind of stock selection, the kind of portfolio policy of a defensive investor, the kind of portfolio policy of an enterprising investor, that is being dealt with in chapter 4, 5 and chapter 6, 7. The most important chapters are chapter 8 and chapter 20th. Chapter 8 is regarding the investor and market fluctuations, and chapter 20th, that is the margin of safety as the central concept of investment. These two chapters, why I am saying are important, because Warren Buffett specifically mentioned in his interview that these two chapters are must read from this whole book, because they are totally talking about the concepts that he really admire, or the really he finds that they are really of great use for any investor. So mind it, chapter 8 and chapter 20, you all must remember that these are to be understood, and you must have to grasp the essence of the book. Then there is other chapters, like chapters regarding investment in investment funds are there. Then the investor and his advisors, chapter 10 is there. Regarding a lay investor, you have one chapter dedicated. Then there is a chapter about per share earnings, and there is also a comparison being made of some listed companies by Benjamin Graham in this book. Then we have stock selection for the defensive investor, chapter 14. Chapter 15, stock selection for the enterprising investor, and he has also dedicated one chapter to convertible issues and warrants. Then some case histories are being discussed, so some case studies, as well as chapter 19 that is showing about dividend policy of the management. So this is the whole structure of the book, and in this way he has dealt with various topics, and he has tried to inculcate into the minds of the readers that they have to take investment seriously. They shouldn't do just take their money and just lose it in the market. Then some appendices are also there, wherein he has talked about some case history, some super investors, which we will discuss. Once Benjamin Graham, he said that he hoped every day to do something foolish, something creative, and something generous. And I would say that the gist of his book is in his core principles which he developed, which are still valid today. For example, first is that the stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business. So one should understand that whatever you see as a stock, it's an ownership business is an ownership interest in the business, and a business which is actually running, and this business has certain underlying value. The stock has the value, and this stock value shows the value of that business. Then next principle which he says is that regarding the market is a pendulum that swings between unsustainable optimism and unjustified pessimism. So whenever you are an optimist, that will make the stocks too expensive, and if you are a pessimist, it will make them too cheaper. And who is an intelligent investor? He is a realist who sells to the optimists and buys from the pessimists. Next principle of BenjaminGraham is that future value of every investment is a function of its present price. Higher the price you pay, lower your return will be. What he is trying to say here is that whatever you pay today, that will decide how much you will earn from it. This is the way, because if you should always ask how much I have to pay, how much I have to buy this stock. Then only you can understand that your profits, you can gain the profits which are really worth to have. Then next is the principle regarding margin of safety, that we need never overpay, no matter how exciting an investment seems to be. And thereby he always says that an investor must understand he can never be free from the risk of being wrong. And last is the secret to your financial success is inside yourself. And we must understand that any Wall Street fact, or I would say any fact or price that is being shown of a stock, if you see in the exchange and if you consider it as a fact and just on the basis of faith, then you are not going to be successful. You have to understand that you have to be confident and patient and critically thinking about the value every underlying every stock whichever you see has got. So by developing your discipline and courage, you can refuse to let other people's mood swings govern your financial destiny. So in the end, how your investments behave is much less important than how you behave. So in a way, BenjaminGraham through his book is telling your own personality traits do matter to be successful in your investing career. Thanks.